Hello everyone, welcome to Itoday Apéro number 7. Yeah. Welcome to Switzerland. We are live from Lausanne, Switzerland, with a lot of people today. So people, if you can just say hi to the camera. Woohoo! Hey everyone. Thank you so much for being live with us. It's the first Itoday Apéro of 2022. This is so great to have all of you live. And today, today is a very special day because we welcome an innovation superstar. You're gonna discover in a few minutes who he is. But before that, maybe you're wondering about the name Itoday Apéro. What is that weird name? So just so you know, an apéro in Switzerland or France, in our region, is like a tradition. It's kind of like a happy hour, right? So if you want to have good time with friends around 6 p.m., kind of 5 p.m., you meet with your friends and you take a good bottle of wine, looks like this, or a beer or Coke or whatever you have in your fridge, right? And you just have a good time and you chat with friends. So I'm from a family of winemakers, so you know the tradition of Itoday Apéro. This bottle, this one is gonna go straight to Milwaukee, USA, because our guest star of today is gonna receive it. And I have a second bottle. Okay, for real, it's the same, but I'm gonna have a second bottle and I will send it to one of you guys. So if you have a good question, if you interact well, we are super happy to send it to you. So our guest of today is gonna choose who is gonna be the lucky winner, and we ship worldwide. So get ready to win your wine. That's it for the wine. Let's talk about our guest today. Let's get ready. He's the author of the co-author of the book Sprint and Make Time. You can see them right here. Super famous, of course. He's a designer. He worked for companies like FeedBurner, like Google, of course. He worked for companies like Google Venture, GV. He's gonna tell us a lot about this. And now he's a venture capitalist, which sounds like a crazy job. So he's going to tell us everything about venture capital, I hope. And please, everyone, welcome from Milwaukee, USA, Mr. John Zeratsky. Hey, John.
Hey, how's it going?
Good. Thank you so much for coming on Itoday Apéro. John, so this is great having you.
Yeah, this is a pleasure. I was saying to you and Egle before we joined that I feel like this is more like talking to family than talking to some big public event. So this is super fun, and I only wish it was a little bit later in the day so I could enjoy some of that wine.
Actually, like in here when we have an apéro, we drink like it's 11 a.m. So it's the same, right? You could already start. Anyway.
Yeah.
So thank you so much, John, for joining us that early in the morning. Maybe before we start, can I ask you to give us a bit of background about who you are and about your journey in design?
Yeah, I'm one of those people who's never been able to settle on one job or one title. So, but I think the theme that has connected all of my work has been design. Started out early 2000s when they used to call it web design, so making websites, and then worked at a tech startup in Chicago called FeedBurner that was acquired by Google. Went inside of Google, worked on a bunch of pretty boring advertising products at Google. They made a lot of money for Google, but they were pretty boring. And then had a not boring opportunity to go to YouTube. I was the product design lead for YouTube channels. So when YouTube decided they didn't just want to be a quirky website for cat videos, but they wanted to be a true platform where people could build brands and audiences and businesses. Mm-hmm. And then from there, had an even less boring opportunity to go to Google Ventures when it was just starting out. They were building out this team to go work with the portfolio companies. So after GV made an investment, they'd send us in and we'd help them out, me and other designers, researchers, engineers, marketers. And that was, of course, what led to the design sprint, because we were trying to help all these companies, but we were just a couple of people. So we heard about what Jake had been doing at Google with his design sprints, brought him to GV, started working together. And then we decided to write the book. So we decided, hey, this has been really useful for our companies. Maybe this will be useful for other people too. Wrote the book. and we're almost up to the current the current date. But I left GV. I took some time off, did some travel, but I was getting sucked back into the world of startups and venture capital, and decided last year to start a new venture capital firm. So basically, trying to do design work in a way that is really connected to the core challenges and things that people care about, and do it in a way that is really aligned with the people that I'm working with. So those have been sort of the driving forces throughout my career.
Awesome. Yeah, this is great. So Character was kind of a secret project, right?
Yeah.
Until December.
Yeah, and not entirely because we wanted it that way, but actually because the laws, I'm sure every country has laws like this, but the ones I know about are the ones in the United States. The laws here about if you're raising a new investment fund are very strict, and you can't really talk about the fact that you're raising money, because then you might get into trouble if somebody who isn't supposed to invest or something, finds out about it. So anyway, yeah, we had to kind of keep it a secret, which is not how we usually operate, as you know. Jake and I have done a lot of, we like to write about things and speak about things and kind of pull people in. So we had to keep it a secret, but we finally announced it on December 1st of 2021. So it's been pretty exciting to finally be able to talk about it in the public.
Can you tell us how many startups do you have already part of the VC?
Yeah, we've invested in 7 startups already. And it might sound like a lot, or I don't know, maybe it doesn't. It would be a lot if we had just started in December, but December was only when we announced it. We actually started officially back in April. So our first investment was in April of last year, and then we made the most recent one was just last week. So really up to date. But yeah, we will probably invest in 6 to 8 companies per year. So we're trying to stay on that pace. It's hard because everybody that we invest in is so interesting, and everybody that we meet with is so interesting, and they're all working on such exciting projects that we want to invest in all of them. But we only have $30 million. We don't have unlimited amounts of money to invest. So we're learning, what is kind of the perfect company for Character? What is our sweet spot for investing?
I like the way you said, well, we only have 30 millions of dollars. It sounds like a lot of money, right? and maybe the question that everyone here wonders is where did you find all that money? Is it yours? Are you rich, or is it others people's money? How does it work?
It is other people's money. So I can give you just a bit of a primer on venture capital. So a venture capital fund, you have the people who run it, who are called the general partners. These names are kind of weird, but the general partner, and they go out and they raise money from what are called limited partners. And these are people, some of them are individuals, some of them are big institutions or organizations, and they want to invest in startups. But either they don't know how to invest in startups, or maybe they don't know any startup founders, or maybe they would like to invest in startups, but they want to diversify their investments. So they want to have a little bit of money in a lot of startups. So these limited partners, they give their money to us. So we kind of gather it together, we pool it into a fund, and then we go and we make it our full-time job to go out and find great companies. We invest in them, we support them, help them be successful. And so the way we found $30 million was by having a lot of meetings. I don't even know, but hundreds and hundreds and hundreds of meetings. And this is the first time that we raised a fund. Jake and I, we worked at Google Ventures, where the money all came from Google. That was somebody else's job to talk to Google and sort of negotiate with them. And then we have a partner, another person who works with us named Eli, and he had worked at a different VC firm. But he, it wasn't his fund. It was, he was an employee of the fund. So this is the first time that we're all doing it together. So it was a lot of trial and error. It was honestly a little bit like sprints, like user research. We made a lot of different prototypes of our deck and writing up documents about our strategy and how we plan to invest. And then we did a lot of test interviews, talked to a lot of our customers who are these limited partners. And, eventually we started to hone in on, this is the type of person, this is the type of organization who's looking to invest in a fund like ours. And it took us like almost a year to raise all the money. It took us like maybe 10 months or so from the very beginning to when we had our final closing for the fund.
Was it like a goal to reach like a milestone to reach 30 million, or basically it's what you could get, like, with how much should you start a fund basically?
Yeah, it was our goal. And basically when we were deciding how much we wanted to raise, we had to consider a bunch of different factors. We needed to consider, how many companies do we want to invest in? And since we're running design sprints with every company, we couldn't invest in 100 or 200, that would be impossible. But on the other hand, we didn't want to invest in only 5 because venture capital is very risky. And so we wanted to have some diversification. So our partner, Eli, he's much more quantitative than me and Jake. He has a finance background. He studied math in college. So he was very good at figuring out, okay, what's the ideal number? And then we had to combine that with how much money do we want to invest into each company? And that was, we had to learn about the market and how the types of companies that we want to work with, how much money are they raising? How much money do they need? What percentage ownership would we have of those companies after we make the investment? Then we needed to think about how much we could raise as a new fund. We couldn't go, even if we decided we wanted to raise 10 times as much, it just wasn't going to happen. It wasn't possible. So we needed to be realistic. So we had 30 million as our target from the beginning. What we actually said was, I think, 25 to 30 million. And then we also came up with another number, which was the minimum number that we could raise and still do it. And so that was around $10 million. So basically the way we did it is we didn't make anything official until we got to 10. So once we get to 10, then we made everything official. We got the lawyers, we got all the documents, we signed everything, got people committed, got them to, send us the first little bit of money. And then we could start making investments. And that was when we made our first investment. That was back in April. But then once we, kept going, we had some momentum. People could see what we were doing. It wasn't just a slide deck, it was real. So then people, were committing to give us more and more money until we got up to close to 30. And then we said, okay, we're good. Let's cut it off. Let's focus on now doing the real work, which is making investments and running sprints with our companies. And let's put a pause on fundraising, at least for a little while.
Awesome. If you look back at what you were doing at GV, I guess you were more designing and facilitating and writing the book, right? Were you picking the startups or choosing them? Were you on that side of the company or not really? And this is something that you had to learn.
Jake and I both we got to help out with choosing the companies and deciding who to invest in, but it wasn't our primary job. So there was a team at Google Ventures who all they did was find companies and then decide whether to invest and negotiate the investment. But when they got to a point where they were, seriously considering a company, that founder would come in and this was back in the glorious old days of in-person everything. So that person would come into the office and, they'd give a presentation. It's sort of like what you imagine happening when a founder is pitching a VC. And when those meetings happened, then everybody from GV was welcome and encouraged to attend. So me and Jake and the other design partners, engineering partners, marketing partners, et cetera, we were all encouraged to attend. And then we were all able to give our input on that company, on what we thought. And one of the cool things that we came up with at GV that we do at Character as well is the idea of an individual scorecard. So instead of, everybody just sits back and says, oh, that's pretty interesting, and then after the founder leaves, you have a conversation. Instead, in this, will not surprise anybody who knows about design sprints. When the founder would leave, instead of, talking, we would all put our heads down and we would start making notes and writing down, scoring, here's what we think of this company. So we got to contribute with that, but no, the short answer to your question after all that story is that I had not been responsible for making investment decisions. Mm-hmm. Eli had been. That was all he did. So he brought that, and we learned from each other, and we continue to improve the process that we use to make decisions, and hopefully we'll improve the quality of those decisions. But it'll take a little while to learn if we're actually making good ones or not.
Like, do you think that being a designer, does it give you any unfair advantage, on choosing like the startup? Like, because I'm thinking about myself, right? I'm trying to buy some stocks and I make horrible decisions. So and I'm also a designer. So are you just better than others with all the knowledge that you have acquired, or not really?
Well, for what it's worth, I'm horrible at picking stocks too. So okay, every time I buy an individual stock in the stock market, it always goes down. Even when the rest of the market is going up, it always goes down. So I'm not good at that either. But that's because investing in a stock is totally different than investing in a startup. When you invest in a startup, you get to sit down with the founder, you get to understand what they're doing, you get to, in our case, we get to work with them, we get to kind of help them out and get behind the scenes. And so I think that the fact that we're designers gives us a big advantage because, a lot of founders, they like to think about the market and the strategy and the, fundraising and all this big picture stuff. But none of that stuff matters if you don't build a product that people want and you don't have a way of reaching those people, finding those customers and getting them onboarded. And so, I think that, Jake and I in particular, we have worked with so many companies and we've seen so many cases of products that work well or products that don't work well, that when we look at what somebody's building, we just have a very intuitive understanding of, is this going to work? Or maybe even if we don't know if it's going to work, we can talk to the founder and we can understand, are they going about building this business in a way that means they're going to figure it out, right? Even if they don't know today, and even if we don't know, do we think they're on the right path? Are they just sitting there with the doors closed and building something perfect for 6 months? Or are they out constantly testing and talking to customers and trying things and building prototypes? So I think that's sort of the core idea that we've raised our fund on, is that, we have this unique way of looking at the world. We have this unique way of supporting our companies. It comes down to, product and go to market, or, product market fit. And so, yeah, we 100%, 1,000% believe that having that perspective and that approach is going to make us better investors.
That's cool. Do you, so you did work at GV, right? And now you're creating a new VC. So like, what are the recipes or the way it's functioning? Like what do you take from GV? What do you copy? And what are the things that you want to do differently?
That's a really good question. The most important thing that we brought from GV is the design sprint, obviously. And I think more broadly than that, it's the idea that a VC, an investor, can do more than just provide advice and provide feedback and make introductions, that it's possible for an investor to actually work hand in hand with a founder. And a lot of investors can't do that. And they can't do it because they don't have the right kind of background or the skills or experiences to do it, or they don't have a model for doing it at scale. Because in the early days when we joined GV, at first, we also didn't have a model. This was before the design sprint. And so we would invest in a company and then I would just go work with them and help them out. I would just do the design work with them, but it doesn't scale. And so, if we hadn't created something like the design sprint, we wouldn't have been able to do that work to help lots and lots of companies. And so, most investors, they either don't have the skills or experience because they haven't been, working inside of startups for a long time, or they don't have a model to scale it. So they kind of fall back on these things that are naturally scalable, which are, again, giving advice, giving feedback, making introductions, et cetera. So that's the most important thing. There's some elements of decision-making that we also have taken and built upon. And I already mentioned this idea of scorecard. When we meet with a company, we individually rate or score the company before we have a conversation about it, because we want to try to eliminate narrative bias. We don't want someone to say, oh, that was so interesting, and that colors what everybody else is thinking in the room. Just like on Wednesday of a design sprint, when we're making decisions, right? We want to keep everybody's sort of opinions separate until we're ready to share them all at the same time on a level playing field. Those are the main things. I think the one thing that's really different, first of all, Character is way smaller than GV. We are, let's see, 10, 100, we're 3 orders of magnitude smaller. So no, 2, yeah, 300, we're two orders of magnitude smaller. So we're like way smaller. But I think the thing that I hadn't really thought about a lot, but Jake pointed out, is that there's a really different relationship that we have with founders, because we are both investors and we're the designers or the sprint leaders. And at GV, even though GV believed in us, GV, we were partners. We had ownership and equity in the company. It's not like we were off to the side, but still there was this handover. There was like somebody made the investment and then they handed them over to us, and then we tried to help them out. Jake pointed out in some of our very first meetings with founders that when we are running a sprint, it's totally different, because we're also the investors. We're the people, we represent the money from the limited partners. We have our own money, a small percentage of the fund is our own money, our personal money. We have skin in the game. We're making that decision, and then we're there and we want what's best for the company. Because everybody's incentives are aligned. So that's not like a tactical thing. It's not like a process or anything, but it's more of a structural thing that's quite different from GV, but I think is really unique and really special about what we're doing.
Like when you are facilitating a sprint for one of your startups, right? So you're obviously the sprint leader, but are you participating? Like, are you sketching, or do you prefer to stay neutral? What's the flavor for you?
We try to participate as much as possible, because I think that sprint facilitation is really important. As you know, the difference between a bad facilitator and a good facilitator is huge. But Jake and I and the other people that we work with are also really experienced designers. We've designed a lot of stuff. We've seen a lot of stuff. And so we think that if we can not just facilitate, so we're going to facilitate, but we can help even more if we also participate, as, provide sketches, really actively participate in making decisions. And then I think it's also connected back to the fact that, we have skin in the game in terms of the investment. Everybody in the room is going to make money if the company does well. So I think that we could provide a value to the startups by just facilitating, but we think that we can provide even more value. We can be an even more helpful investor if we're also really participating in the sprint, if we're really contributing our ideas, if we're taking an active role in sort of shaping the direction of that company. But it's kind of hard to do. As like facilitating a sprint, leading a sprint, it takes a lot of energy, it takes a lot of attention. And so that's part of why we always try to have multiple people from our team in a sprint. That's why, me and Jake, or me and Jake and Eli, or me and Eli, because it means that we can kind of share the responsibility of facilitation while also having some mental bandwidth left over to contribute our best ideas.
Yeah. Have you been in the situation when you weren't facilitating, but you were actually the decider? Or it's always the CEO?
Well, if we're working with a startup that we invested in, then it's always the CEO. But we have run some sprints on our own internal stuff for a character. So we used a brand sprint and a name sprint to come up with the name character. We are running an opportunity sprint in a couple of weeks about this new program that we're considering developing. And in those cases, Jake has been the facilitator and I've been the decider. So, but normally our philosophy when it comes to working with our startups that we invested in is that, we exist, our job is to support them and serve them and help them be as successful as possible. So I don't think it would ever be appropriate for us to be the decider in one of those sprints.
Yeah, awesome. I guess there are a lot of questions about how did you choose the startups, and what are the key things you are looking at a startup. Like, is it the people? Is it the tech? Is it the field? Wow, yeah. What is your magic recipe?
Yeah, we created a decision-making framework that we call OATS. So OATS, OATS. It has nothing to do with food, but it's just easy to remember. And it stands for opportunity, approach, team, and success. And then within each of those categories, we have maybe 3 to 5 or 3 to 6 criteria that we look at. So actually, I'll pull it up right now and I'll just give you an example in real time while we're. So for example, within opportunity, the first section, the 3 criteria that we look at are one, is it a real problem? And meaning that, is it a nice to have thing where it's like, oh, that'd be cool if you could do that? Or is it like, oh my God, this is something that, causes me to lose money every day. It drives me nuts. It's, whatever. Is it a, sometimes people talk about vitamins versus painkillers. Like, is it a painkiller? Is it really helping somebody fix this big problem that they have? The second criteria within opportunity is market size. So how big is the industry? And not just today's industry, not just, how much money are people spending on this sort of thing today, but how much could they be in the future? Our first investment is a company called Phaedra, which doesn't sound like the sort of thing that we would invest in as designers, but it's this software to optimize the heating and cooling systems in factories. And I can talk about why we think it's interesting as designers, but it's a good example of where the initial market size, if you only look at, well, how many people today want software to optimize their energy usage in their factory? Well, maybe not that many, but if you think about it, in 5 years or 10 years, you could have this software installed in every factory in the world, helping to control the systems, helping to optimize, helping to keep them running smoothly. So we think about that. And then the third criteria under the opportunity is competition. So it's not simple as, is there already a lot of competition, but we try to look at that unique situation and say, okay, who are the competitors? Not only direct competitors, but what are the substitutes? Is this competing with some other thing that already exists or that they're already doing? And if so, what are the benefits or the downsides of that? So that's just the O category. But so that just gives you an example of like for the O, which is the opportunity, A, which is the approach, which is basically about, okay, that's the opportunity. Now, what are they doing about it? What's the product they're building? Like, what's their strategy? How are they going to market? Team, same thing. We have some criteria around, the technical skills and the design skills and the ability for the team to raise money and the ability for the team to build and validate the product. And then the success category is all about what they've achieved so far. So how many customers do they have? How much revenue do they have? How quickly are they growing? And that's kind of the framework that we use. And of course, the assessment, the rating or scoring for each of those components is subjective, right? And that's where our experience as designers and investors for the last 10 years comes into play, because we believe that we can make the right assessment on each of those categories. So there's no secret formula. It's not like we can just plug in all the data on the company and spit out like, should we invest or not? But we do think that, just as we do in a design sprint, we think that by having a structured approach to decision making, we can make decisions that are high quality, decisions that are free of bias, that are inclusive of everybody in the conversation, and that and this might even be the most important, things that give us a record of our decisions over time, a structured, consistent record, so we can look back in 6 months and you can say, wow, that company, we rated them like this, but turns out they went on to be really successful. What was going on? What did we miss? What did we get wrong? And how can we improve the quality of our decisions over time?
Can you, I don't exactly know how it works with VC, but like, do you sign a long-term contract with them, or can you like break up with a startup that is not doing a good job? Like, how does it work?
When we invest, the like simplest way to think about it is that we are buying a piece of the company. So in that way, it's like buying a stock. The mechanics of it are a little bit different, but we give them cash. They put the cash in their bank account, and then we get stock. We get a percent ownership of the company. So there's no contract in that sense. It's a transaction that happens. The only way for us to break up with them is to sell our stock, that our ownership in the company. But because these are really early startups, there isn't really a stock market. There isn't really a market for those types of shares. So it's virtually impossible, and it's very uncommon for an investor at our stage to sell or to break up with a company. Maybe in 5 years, maybe they've grown, but we think we would have potentially opportunities to sell down the road. But if in 6 months we say, oh, it's not working out, we can't really get out of it. I think the only thing that we can do is to spend less time with them. And that's not what we want, of course, but from a financial perspective, there's no obvious way for us to sort of end that engagement with them.
All right, so we are getting some questions from the participants, really good ones. Jamil,
Jamil is watching live on LinkedIn, so he's not on Zoom, and he was asking how often do you sprint with your teams?
So I don't exactly know. I can tell you how it's been going so far, but we just, relatively speaking, we just started. So we don't quite have the feel for it yet. What we have been seeing is that within the first couple months of making a new investment, usually the team is ready to run some type of sprint, either a brand sprint, an opportunity sprint, or a full design sprint. And we've only had one company that has run multiple design sprints. And that was that first investment I mentioned, that company called Phaedra. We invested in them in April, and they had a lot of sort of back-end technology work to do. We ran a design sprint with them in September, and then they actually ran their own design sprint in November, but we sort of coached them. So we weren't there for the full 5 days of the sprint, but we coached them and they ran the sprint on their own. We had to kind of like do some math based on like how often we thought companies would run a sprint, and then like compare that to what we were doing at GV to make sure that we wouldn't find ourselves in a situation where everybody wanted to run a sprint every week and there was no way we could possibly do it. So we assumed that we would be running sprints 1 week per month, which we're not quite at that level yet, but that's because we've only invested in 7 companies so far. And we've assumed that most of the startups that we invest in will run maybe 2 to 4 full design sprints per year where they need our help. But that over time, they will run their own sprints, and we'll be able to just help them out a little bit here and there. So those are some of the assumptions that we made, and it's more or less working out so far, but there's a lot of things still to figure out as we continue to go.
This is super interesting, actually. Like, are you kind of like, like giving the facilitation power to someone, like you're training someone inside the startup who will become the facilitator? Like, yeah, totally. And for Phaedra, like we didn't do it on purpose, really. Like we ran a sprint with them, and then like a little bit later they emailed us and they were like, hey, we decided to run another sprint. Like, I don't know if you guys are free to join us, but like, it'd be cool to have you. And somebody who had been in that first sprint, she decided she wanted to be the facilitator. She's like, this is awesome. The CTO, one of the co-founders, he was like, an engineer, he was like, this sprint thing is so much better than how we had been designing products. So he was really excited about it. So, maybe when we get bigger, we'll have like more of a training program or something. But for now, it's just kind of organic where people pick it up and decide to run with it. And I don't know what you think, but usually, at least in my sprints, there's always one person, who is the perfect person for facilitation, and you can spot that person right away, and that's the person who comes to ask questions and looks exciting. So
that's totally right. Yeah, that person is always there, and then there's like when sprints really stick in a company, there's usually there's like some stealth proponents, and I think in this case that I was just mentioning, it was the engineer, the CTO, who was like, he's not running the sprint, but he like behind the scenes was like telling the team like, oh, we got to do a sprint. Like this is the way to figure out our product. So I don't know if you've seen that, but like the sort of the person who's going to take over the facilitation, and then also kind of the behind the scenes like champion who's sort of like pushing it. When those two elements exist, then they're gonna take it and run with it on their own.
So something we get a lot is people asking, can I just come to observe the sprint? Like being a fly on the wall, and because they want to see and to learn, and it makes it a bit awkward, but
the companies that we invest in are too small to have any observers. They're only like 6 people, so everybody's in the sprint anyway.
There is Steven. Steven has a really good question. Do you want to open your mic?
Yeah, I think is it open or is it...
Yeah, we can hear you.
Yeah.
Okay, great. First of all, thanks for being here, John. It's an honor to listen to you, and congratulations on your new venture. I wish you all the best. Just to know, as an investor, since you're, as an investor, do you think it changed anything to your way of facilitating your sprints? Just because you might be a bit more picky on like the business model, on the potential, do you think to be more challenging the ideation process, the concepts, and on the decision on the winning concept? Does it change anything, or is it all this the old way you did at GV?
That is a really good question, and I think the honest truth is that I probably care more now than I ever have before. Like even at GV, where like we had skin in the game, we had an incentive, but GV was so much bigger that I think, and I'm just like being totally honest here. Like I think I had this thinking back that it was like, okay, well, this one doesn't work out great. Like there's this other one. There's like hundreds and hundreds of companies. Plus, we were like, we were still figuring out the design sprint. Like we hadn't fully developed the process itself. And then I also experienced that a lot when I was working like as a consultant, working with companies, especially bigger companies. And it sounds bad, but like if I'm running a sprint with a bank, I just like, I don't know, I'm there, I'm present, I'm doing the best I can, but like, I'm not going to put my finger on the scale and try to change the outcome if I believe they're making the wrong decision. But as an investor, I totally feel that way. I mean, I feel much more engaged, and I feel a great sense of responsibility for them to make what I believe to be the best possible decisions. So tactically, I don't know how that changes things, but certainly my mindset going into it is quite different.
Great, thanks.
Yeah, good question. Thank you.
I actually have a question about like you have created the sprint to, like to avoid a lot of meetings, right? But then the sprint is always like synchronous, in sync. Everyone is together in the same room. Do you see it like the way you work with startups, or are you getting way more asynchronous right now?
So far, we have continued to run sprints synchronously. And like everybody here knows this already, but I think that is it's just such an important part of the core philosophy of a sprint, that the team is together, that they're focused, that they're engaged, that they're putting their energy 100% into the most important problem that they face. So I don't see us moving away from that, with one exception, and that is that there's this interesting situation that we've observed, that before somebody starts a company, and before they're raising venture capital money, there's often a period of 3 to 6 months where they are basically just exploring ideas. And they're just going out and talking to customers, and they're thinking, there might be something here. There's kind of a cool opportunity. And sometimes we get to talk to people when they're in that phase. It might be if you've read the Sprint book, about Flatiron Health. And there's a couple people who left Flatiron Health. They're both engineers, and they're in this situation right now where they don't really have like a clear business idea, but they're exploring some things. And they have run several, essentially sprints, but kind of asynchronous, kind of like they go through all the steps, but because it's just the two of them, and because they're in this broad exploration mode, they haven't, been sitting together in the same room from 10 a.m. to 5 p.m. each day doing it. So I don't know if that's good or bad, but it's something that we've observed, that we'll meet with them, and we're not there with them because we haven't invested and they're still too early for us to invest, but we'll kind of coach them and give them pointers and say, hey, I think, you've been talking to these customers. That's great. I think if you make a prototype, and use that in your tests, you'll learn a lot more. Here's the process you can use. They're kind of doing these sort of asynchronous-ish types of sprints. So I'm interested to see where that goes and what happens with that. But for the most part, we've been 100% synchronous all together, same time, totally focused. Virtual, obviously, but hopefully that'll change before too long.
Actually, like when you run sprints full week, synchronously, like we get pushbacks from big companies because it's sometimes because it's a huge time commitment, and it's a focus, that they need to have. And in a podcast, you said, wait, I quote you, committing time for focus, like on a design sprint, is always hard, but it's on purpose. And I really love that. So can you elaborate on that?
Yeah, well, I think in the context, especially of a larger company or an established business, part of the magic of a design sprint is just the decision to do it. It's just the decision to say, this thing is so important that we are going to focus on it. We are going to clear our calendars and get in the room. And even if you did that and then you put the book away and you just worked, you'd probably still get a lot done. Like, it would still probably be way better than whatever you were doing normally, just like having meetings and like sending emails and stuff. So that I think is the core idea that I believe in really strongly. But I think it's even more interesting with startups, because the things that you do in a sprint, figuring out, what are you building? Who are you building it for? Do those customers care? Do they understand it? That is all a startup exists to do. A startup doesn't have anything else going on. They don't have committees. They don't have, ongoing project, check-in meetings for projects that have been going for the last, 18 months. All they're doing is trying to figure out, are we building the right thing for the right customers? And so for them, it's a very natural fit to run a sprint, and it's not hard to clear the calendar, because they're not clearing it from anything. They're clearing it from doing what they were already, working individually, working in an unstructured way on product market fit, to now working in this very focused, structured way on product market fit. So it's much more of a natural transition and natural fit for what they're doing. But yeah, that decision to focus is very purposeful, and it's very important if you want to really make progress on hard things.
It's really part of the experience of the sprint, right? It's what makes it in a way disruptive, but for good. Like it's really bringing a change in the way people work, and that's the point. Yeah, focus.
Totally.
Paul. So Paul has a great question. I don't know if he's still around. If you can open your mic.
Thanks. Yeah, John, I was curious about bias from founders, right? Because founders, their ideas or their products are like their children. They're very passionate about it. So when you step into a sprint, does the founder at times, have that bias as part of the process? And how do you, as an outside advisor or your team of advisors or others in the company, work to resolve that?
Yeah, that's a really good question. And I have a question for you, which is, are you really in Milwaukee?
I am 30 seconds a day.
That is so cool. Well, hello from the Upper East Side. That definitely happens. And one of the things that we look for when we invest in a company is, and this is actually one of the criteria under approach. It's called weakly held vision, which might sound like kind of weird, but we believe that the most successful founders, they don't hold on to their vision too tightly, because we've worked with, Jake and I could tell you some horror stories from Google Ventures of working with companies where the founder had too clear of a vision, and their whole mindset was, I just need the team to bring this vision into the world, and I know it's going to be successful. It's never successful, right? It never works. Founders who are successful, they see an opportunity and they have ideas, they have beliefs, they have hypotheses, but they're willing to change when they learn. They're willing to, test things, to validate their assumptions and change direction when they learn something new. And so we try to get ahead of that, of the situation that you're describing, by investing in the first place in founders who aren't holding on too tight to their vision, so that so it doesn't create that conflict in a sprint. But of course, there's always going to be a certain degree of people believing in what they believe, and particularly founders who they've raised money for an idea, they've had some success so far with what they're doing. So I think that we don't do anything special to try to counteract that or address it outside of what we would do in a normal sprint, which is, make sure that their idea is captured and represented on a level playing field with all the other ideas. Make sure that everybody has a chance to weigh in, but then ultimately defer to the decision maker. And so it's basically, who is the founder? Who is the CEO? So it's basically, okay, there's, we see this opportunity, this problem, this thing we're trying to figure out. There's 10 different ways to do it. Let's think about why each of those 10 is a good idea. Let's sort of hear the pitch or see the pitch for that. But then, if at the end of all that, the founder says, you know what, I've seen it, I've seen you, I've heard you, I still believe my way is the way to go. So be it. At least we went through that process. At least we gave that founder an opportunity to evaluate different options, the opportunity to learn. So, I think a lot of that stuff is already baked into the sprint process, but we do try to get ahead of it by evaluating founders on that measure of weakly held vision from the very beginning.
We actually had that, like on the sprint day one, the founder is like, I know exactly, like he was annoyed. He was like, I really don't know why we are doing this, because I know exactly what we should do. And he was telling his vision. Then on day two, he was sketching. On day three, there was a sketch that was exactly what he was saying since the beginning, so we knew it was his. And then at lunch, day three was like, okay, my thing wasn't the best, so I'm gonna pick the other one. That was good. Took time.
That is really good, yeah.
So we have a great question from Timothée. It's the same than Jamil. Both of them have the same question. Timothée, do you want to ask?
Yes, thanks, Steph. Hi, John. Yeah, and some time ago, you talked about brand or name sprints and opportunity sprints and full design sprints. So can you tell us what's the structure of these? Well, we know very well what's the design sprint, a full design sprint, but what's the difference with the brand name sprint and the opportunity sprint?
Yeah, so I'll start with the brand sprint because it's easy, because we wrote an article about it several years ago when we were still at GV. So maybe Steph or Egled, maybe somebody can find that and paste it into the chat. But it's really, the goal is to it's only half a day, it's only 3 hours, and so when you take a 5-day design sprint and you shrink it down to only, well, when you shrink it down at all, you have to cut stuff, right? You can't just accelerate all the steps. You have to cut things out. And so when you shrink it down that much, the brand sprint is it's essentially just parts of Monday. It's like, all it is pretty much like getting the team aligned on why they're doing what they're doing and what they care about, what is important and essential to that team and that brand. And then sometimes, and we have a PDF about this that I could send, maybe Steph, you can send it out after or something like that. There's a PDF that describes this thing that we sometimes tack onto the end, which is a name sprint, which is essentially like a note and vote. It's like several, if you're familiar with the note and vote from the design sprint, it's essentially like a couple rounds of note and vote where we first identify themes for a name. So categories, like nature or exploration or, space, and then another couple of rounds of note and vote where we identify actual names for the company or for the product or for the feature related to those themes. And it builds off the brand sprint. So that's that stuff. It's all pretty well documented. The big difference between the opportunity sprint and a design sprint is when you do a design sprint, you already know the opportunity. So you understand the problem you're trying to solve, you understand the opportunity that exists for your product, and you're focused on solutions. So in the context of a known opportunity, you're generating and evaluating and testing solutions. You're trying to figure out, what should we do in order to achieve this goal? An opportunity sprint is essentially the step before that, which is, there are a lot of different opportunities. There are different parts of the market. There are different new product categories that we could consider. Which one do we think is the most promising? Which one should we prioritize and spend our time on? And then the next step after that would be to run a full design sprint. And I can similarly, we just have a doc that has the outline for the opportunity sprint, and it's not ready to share, and it's, someday we'll get around to writing about it publicly. But it's essentially like parts of Monday, Tuesday, and Wednesday. So it doesn't include the prototyping or testing, because it's mostly about deciding and prioritizing internally which opportunity does the team want to focus on. So, hopefully Steph or Egled can send that out to you, but that's it, in a nutshell, that's kind of what it is.
Yeah, it's actually in the chat for the brand sprint. And opportunity, you just have to write the article. There is a great question from Sabrina.
Hi, John. Nice to meet you again.
Nice to see you.
Nice to see you too. I have a question. So when you run the design sprint, do you do that before you invest or after you invested?
That is an excellent question. And we run sprints after we invest. We would like to run sprints before we invest, but we haven't figured out how to do it yet. And what I mean by that is startup fundraising is really weird, because if you imagine that there were 100 startups in the world, 99 of them, they basically just need to raise money from anybody. That sounds bad, but like, they need money to keep the business going, right? And so investors are sort of in the position of power. They can say, well, maybe we'll invest in you, maybe not. But for one of those 100 startups, it completely flips, where all the investors are trying to invest in that one company. So there's a inverted competition where the investors are all competing for the ability to invest. And in those situations, what we think, and we may be wrong about this, but we feel that to say to a founder, hey, we're interested in investing in your company, but first you have to spend a week with us. We think that's a really hard pitch to make. So we had some ideas for how to get around it that we're working on, but so far we haven't quite figured it out. But we do think it could be really interesting because we could learn a lot about the company, about the opportunity, about the team, if we were to run a sprint together. And the team they could learn a lot about us. They could learn what it's going to be like to work with us. So it's something we would like to figure out. But so far, we are still in the GV model of we invest and then we run the sprint.
But do you think that, au contraire, so I'm using my French, it's kind of like a USP that you have the sprint and that startups are coming for this reason? Like, is it the case, or they come because they just need the funding and they could pick another one?
The companies that we have invested in, and I believe the ones that we will continue to invest in, they want to run sprints with us. Okay. That's part of the value proposition is I'm going to raise money and then I'm going to have the opportunity to work with the character team, to work with Jake and me and Eli and run sprints together.
There is a comment in the chat: a week in Milwaukee, this is the appeal. I guess that you run remote sprints, right? Or is it in person?
Yeah, we do it remote, but yeah, I mean, once people are a bit traveling more freely and gathering more freely, yeah, it'd be fun to maybe not in the winter, but in general, it'd be fun to have sprint week in Milwaukee for lots of startups who we're considering investing in. Could be cool.
Yeah, that would be a seller, definitely. Yeah. Orit, are you still around? You had a great question. Where are you, Orit?
Yeah, I'm here. Hi.
Hi.
Hi. So these early stage startup, I guess they're early stage, right? When you run a sprint with them, I'm assuming, maybe it's bad, but I'm assuming that it's more of a vision sprint and where they're going to be, that the prototype is something that's more visionary, I guess. That's from my experience with early stage. It's not only early stage, but when they have to really rethink something, and then the problem is that I've run into problems with these kind of companies where they think that this prototype, after it's been semi-validated, it's a roadmap now. And I don't know how to, what do you do with them so that they don't think this is now a roadmap and now you're done with discovering or you're done with talking to users, or, what do you do with them with your startups for that?
Yeah, that's really interesting. We do see that sometimes. That does happen for sure. One of the things that we talk about a lot with startups is the idea of not a roadmap for the features you need to build, but a roadmap for the questions you need to answer. And we often will use the sprint questions on Monday or the risks as the start of that roadmap. So, and we'll talk about it a lot. We'll talk about it before the sprint, during the sprint, after the sprint, and we'll say, okay, for this new product, or for adding on this new functionality to your product, or going and trying to reach this new set of customers with your product, there's a bunch of things that you don't know that you need to figure out. And if you don't figure them out, you might fail. It probably won't work. Maybe there's 5, maybe there's 10, maybe there's 15 of those things. And we try to capture as many of them as possible on Monday of the sprint. But sometimes we capture them outside of the sprint or after the sprint. And so what we talk about during the sprint and at the end of it is, okay, you've answered these questions. Like you put the check marks next to this question and you believe the answer is yes, but now it's time to move on to the next one. And what is the, that's the next question on the roadmap. What is the best way to answer that question? Do you want to do another design sprint, or is there another type of test or experiment or prototype that would be more appropriate for answering that question? So that's how we talk about it, and that's sort of how we coach companies on making this transition from the initial design sprint into what they do next. Is think of it as a roadmap of questions or a roadmap of hypotheses or assumptions, and then eventually it just sort of morphs. I think there's often this idea that like you do discovery and design and then you do implementation, you do execution, but it's not really like that. It's like a gradient. It's like, you figure things out, you test things, and then like you start to make them real. And then if you're like, okay, that part's good, now this part we need to test with. And so it just sort of morphs over time. And eventually you've done everything on your roadmap, but you didn't really think about it in that way. You thought of it in terms of the questions that you need to answer instead. It doesn't always work, but that's what we try to do.
There is one question from Cyril. Are you here?
Yeah, I'm here. Sorry. Looking for the button. Thank you once again for the talk. My question was like, do you see, like, I mean, you've changed the way products were built with a design sprint. Do you see the same thing coming for the VC journey? Like, do you think running a sprint will be a mandatory step if you want to ask for more money to other VCs on your journey as a startup on A, B, and C? And okay, well, you won't have any money on round B if you haven't done at least 2 or 3 sprints before coming in front of me. Do you see that coming as a trend or not?
Not exactly like that, but we do see, and we've been seeing for years, more investors use design, more investors have designers on their staff, more investors running design sprints as part of their process. And even if it's not directly what you're saying, I think one of the things that happens that is similar to what you're saying is that at each stage of funding, there are certain questions you have to be able to answer. So, you have to be able to say, okay, how are you acquiring customers? What is the process of selling a new customer and getting them, set up and onboarded with the product? And design sprints are a really good way to answer those questions. For a startup to be able to say, here's what we've seen when we've tested these ideas with our customers. Here's what we're hearing. Here's the method that we've used to validate, how we put this product into the market. And so it's not like a checkbox hard requirement of you need to run a design sprint to raise money, but the design sprint is such a natural way to prepare you to raise money that I hope we will see it more and more. And that would be, honestly, that would be an amazing long-term outcome, long-term goal for the work that we're doing with Character.
Awesome, thanks.
All right. So I think that's it. Thank you so much, John, for answering all our questions. It was really great to have you. So I would like to show these 2 books. First book, of course, is Sprint by Jake Knapp and John Zeratsky. So read it if you haven't read it yet. And the second book, really, really great book too, is Make Time. It's the perfect companion for Sprint. So Sprint is about work and this is about life, right? John, do you have anything to add about Character, about yourself? Where can we find you online?
Yeah, I'm pretty easy to find online. If you're interested in learning more about Character, our website is character.vc. Mm-hmm. If you know somebody who's starting a company who wants to work with us, send them our way. Otherwise, Twitter and LinkedIn are pretty good places. But we're not hard to find. So thanks everybody. This was fun. These questions were super good. And I'm so glad that I had the chance to come and join you all.
Thank you so much, John.